What is going on, you guys, and welcome back to another episode of Stock Battles. We're here in person in the beautiful Powell River. It's a little bit gloomy today, but it's still nice. And we have a battle. We have another battle in line.
Sadly, our next year isn't up until October. We had a bit of a gap in 2022, so we'll have the next locked in number. But in the meantime, we're going to keep rolling these out and giving you some ideas and picking companies that we think are going to do well over the next year. But pretty much everything we pick usually is for a long-term hold. But I think I want to kick things off today, Brandon.
Good luck.
The company that I have picked for this stock battle is the Kraft Heinz Company. The ticker is KHC, trades on the NASDAQ, roughly $37 US. It's got about a $45.5 billion market cap. I don't have to tell you probably a lot about Kraft Heinz because everybody uses this company, their products, but it's roughly the third largest F&B company in North America and around the 10th largest or so in the world. Measured by market cap, that fluctuates a little bit. Annual sales, $26.5 billion. Now, Kraft Heinz is a well-known and beloved household brand name, right? I want you to pause just for a moment and have a look at this chart. How many of these products do you use? If you look through here, there's going to be some you have in your fridge right now, you have in your cabinet right now.
Peanut butter.
In your pantry.
Kraft dinner.
There's so many. In addition to here, they've got A1 sauce. They've got Cool Whip, which is so cool. Lee & Perrins sauce. They got their salad dressing, their Lunchables, Baker's chocolate. The bottom line here is that this equals customer loyalty. And they have good pricing power because of that. Very inelastic as far as their pricing is concerned. So this is a stock battle. So why now? If I'm looking at now the next year out, well, look at a few things here. In 2020, this company started what I would call really a total revamp. They had, went through the big merger, obviously, with Kraft and Heinz. They made a focused effort to reinvest their money in their iconic brands. And they've really shifted their innovation focus. And you can see the management team back in 2019, the CEO, who's Miguel Patricio, he became chair in 2022. And that's really, I think, when the turnaround started to take hold. We look at Q1 2023 results, and they have seen solid growth. So the revenue in Q1 is up 9.4% versus year over year. The adjusted EBITDA up 12%. The adjusted earnings per share up 13.3%. And I say this is part of what they're calling their transformation momentum path. And I'm seeing, so some real traction being gained here. Part of this change, because you don't think of Kraft and Heinz and healthy food.
No.
Typically, you think of, KD or what have you. Well, they are making a strong effort to make healthier choices, to allow the consumers to make healthier choices. That's kind of the way that the public is going. They're making efforts to reduce sugar in their products, to reduce sodium in their products, simplifying their ingredients lines. And you can see on this chart here with their 2025 targets, I think very aggressive. They're making some good headway with more room to go. The biggest change that this whole turnaround or the whole restructuring has caused, let's take a look at their debt. The debt reduction over the last little while has been very, very impressive. Of course, it increased in the 2015 merger. That was a highly leveraged deal. But when we look at this today, the orange line on this chart is the long-term debt. The blue line is the total debt. We can see that spike up when the merger occurred back in 2015. But in the last couple of years, we can see that really come down significantly. Now, the big benefit to this, of course, is reduced interest costs. So this increases cash flow into the company. In the last quarter, their interest expenses were $227 million. Now you compare that to over about $604 million 1 year previous to that. So this is a material change here with $400 million difference. And they're doing this in a rising interest rate environment. So that gives me some comfort that they actually have traction here and they are moving along in the right direction. They've divested some of their non-core businesses over the last couple of years. They got rid of their nut business back in 2021. Now, I love Planters. That was part of the family for a long time, but that's gone now. Their cheese ball product is gone. Last year in 2022, they divested of their powdered cheese brands. So that's a big change they're going through there. Getting back to this battle today, why would I say I'd want to buy this company today? Let's just get down to valuations. And we look at almost every metric against their peers. Just look at the top part of this chart here. If you look at KHC versus all of their major competitors, they're around 12 or so with their forward, their trailing PEs, etc. Compared to their peers. I mean, they're kind of blowing them away, you'd almost say. If you look at their own price to earnings, next 12 months, trading at 12.7. The sector average is 20.2, I believe, on that. And we look at their price to book, less than 1. So they're trading at 0.9. Again, the sector average is 2.5 roughly. So if you have faith in the sector that people are going to continue to eat, you can really see how the company is making changes there. Also, of course, we love dividends, and the company's currently yielding 4.33%. So I would call that attractive. They did cut their dividend by 36% back in February 2019. They're currently at a payout ratio of about 56%. So when I take that, I combine it with their debt reduction, the reduced debt payments there, I think there's lots of potential upside to increase that dividend in the coming years. Another thing I wanted to look at here is their earnings versus consensus. This company really has seen no love from the analysts out there. If we look back at their 5-year numbers here, look back, the blue line on this chart shows the consensus estimate, the EPS estimate. The orange line is their actuals. And so you can see going back, to 2020, basically every quarter after quarter, the analysts are underestimating their capabilities. They're coming out with bigger numbers. And I think that eventually the market is going to realize, and we're going to see those numbers narrow in there. So that's one thing also I think is really moving in favor of this company. A price target, the current price, as I mentioned earlier, they're trading at about $37 a share. The consensus target is $46. So that's about a 24% upside on there. So if I'm looking at this sort of summary, I'm saying they're a great defensive play, and there's a lot of uncertainty remaining in the markets out there. So we're looking at a 1-year time window that might help there. There's a possible recession coming up. As I mentioned, the prices are inelastic. So the company has a lot of resilience. They're finally showing signs of turnaround, long overdue, but I do believe that they got that traction there. They're obviously undervalued, and given that this is a 1-year battle, Brandon, I'm coming in with Kraft Heinz Company, and we'll see. I don't know what company you're picking, but I'm pretty confident in my vote here, or my pick here, and I'd like to see where people vote.
And make sure you guys vote, because if you like Kraft Heinz, then you got to let us know. Down in the comment section. We did start doing the votes on the community tab too, and that got a bunch. So that's crazy how many votes we got. I think there was a few hundred of
I think 350 or so last time I looked at
versus the comments. So in fact, maybe we'll find a system to look at both. The comments are great. We love the comments, but also if you come across that poll, I guess it's a lot easier to just tally a poll vote than to actually leave a comment. For sure it is.
So, and you kind of see where you fall in there too. So we will definitely have that up at the conclusion of this video as well.
Now, before we move on, I'd like to take a brief moment and thank our video sponsor, Passive. You guys know how much I love Passive. We talk about them on the channel here all the time. Whether you are new or experienced, if you are a DIY investor, this is a tool that you need to know about. Passive is a companion tool that allows you to be a better investor. You'll be more organized, make good investment decisions, and feel overall more confident with your portfolio. Passive makes it so easy to connect your portfolio from a variety of brokerages, and it's incredibly powerful to use. You can manage your portfolio and analyze it as one single piece. It saves you a ton of time, where you can take essentially a 10,000-foot view of your investment positions. Passive returns so much value in time and money because it eliminates the need for crappy old spreadsheets. No more equations, no more calculating what you need to buy and how much. You don't even have to log into your many various brokerage accounts and place those trades one by one. With Passive, you can set a target, let them do the heavy lifting, and all you need to do is review and execute the necessary trades you want in one click. One of the really cool applications you can use Passive for is if you plan to make some big changes within your portfolio, you can actually go in and set up a model portfolio. That way you can better understand the impact of every move you make, how they would work together before you even make them. Passive notifications give you a feeling of freedom that your portfolio is self-managing while you're out doing the things that you love. Now, in terms of pricing, Passive Elite is a bargain at only $99 per year. And as I know many of our viewers are, if you are a Questrade user, you can get Passive Elite completely for free. If you're not with Questrade, there is a free account with no credit card required to get started. This is such an awesome and easy companion tool for all types of DIY investors out there. Down below this video, I'll include a link to Passive for you to go check them out or go visit them on their website. But thank you to Passive for sponsoring today's video. Yeah, no doubt. I think it's an okay pick. I wouldn't vote for your pick personally.
I knew when I picked this, there was no chance that we would overlap.
No, that's a really, mine is a polar opposite. You went for an old, boring company.
Yeah, just like the first number of picks I went on, right? Yeah.
Well, you got to get with the times, Dad, because one thing we do have in common is that both of our stocks do fall into the Berkshire Hathaway portfolio.
Okay.
Something quite unique in that sense. But like I said, two very different companies.
Okay.
I know Warren Buffett has been a believer of Kraft. I believe so, unless he sold it as of recently. I think it's one of the larger holdings, the last I checked.
Yep, there's still holders.
Still holders. Well, my stock is the company Snowflake, a new one to the channel, and probably a new one to your radar. If you're doing is looking at peanut butter and jam all day, I don't anticipate you to know this company.
I am familiar with Snowflake. I'm familiar mostly because I think they bubbled out a couple of years back, and then you've seen
exactly, and that's exactly it. I'll pop up the share price for you, and you're exactly right. Upon IPOing, they did bubble out.
Yeah.
They hit a high of about $400 per share. Had a couple big spikes following the IPO. The stock obviously doesn't pay a dividend. However, it has gone pretty much downhill since, 2022, essentially. And we're sitting today at $170 per share. And I will say this is a high-risk play. We see the market cap of $55 billion. This is a company that is not profitable, as we will look at in a second. And obviously, when you have a stock that is recently going public, this data doesn't go that far back. It does come with its fair amount of risks. But we talk about this battle, and, it is a one-year battle. Mm-hmm. I have a good feeling that this stock's got a short-term opportunity, and I'll explain to you exactly.
I'm all ears, so I want to hear this.
Absolutely, very different than Kraft Heinz. In fact, I would argue. I didn't really chime in, but you just said it. Interest rates were just bumped up literally a couple days ago. What was it? Earlier this week.
Wednesday, this past week.
Yes. Therefore, Canadians are now struggling that much more with their grocery bills and with making rent and paying car payments.
They're buying beans and Kraft dinner.
They're buying non-name brand beans, gotcha. Non-name brand Kraft dinner. So, if you're going to go in and buy, a marked up peanut butter, I think a lot of consumers are going to go for that President's Choice option or the no-name brand. Therefore, a very poor pick given the environment. But that's okay. I guess that's why it's a battle, right? To each their own. Let's move on to Snowflake. For those that are not familiar, Snowflake is a data lake. Lake is an interesting company, but it's essentially a warehousing and sharing company for data, cloud-based data. They work with over 3,000 customers at the moment, and they essentially they consolidate and provide all sorts of data up in the cloud for these big enterprise corporations, which can help them make better decisions. They can make better insights. They can basically analyze this data, therefore hopefully make more money. And I think that's a very important component of the modern day business. To look at the numbers in the fiscal year ending January 30th, 2023, Snowflake generated $1.6 billion in revenue from its United States operations. This is a growth rate of 67.22%. Now, the profits obviously are not showing yet because this is a non-profitable company, but the name of the game for this stock is growth at this point. Even just looking at this chart, we see the acceleration from January of 2019 to the trailing 12 months. In fact, revenues in the trailing 12 months are up at $2.2 billion, right in that 60% growth rate, range. And what I think is actually a positive, given the fact that share price has dropped now, is I think that they are kind of building up their company. I say building up their company. They've been around for quite some time, but on the public markets, they're building up in a tougher environment. And what do I mean by that? Well, we backtracked a couple of years when stocks like this were kind of at their all-time highs. We're seeing a lot of companies like the PayPals and Squares of the world that just traded at these frothy valuations. Money was easy, money was flowing, and you have a lot of shoes to fill when you have such a sky-high valuation, just given the base of the market. Well, it's a very different environment, and assuming this company is able to kind of lay the foundation of their business and grow, at the clips that they're expected to, when times are tough, when the market does flip. I think it's kind of a silver lining, right? It's building when things are slow. And I do genuinely think that when the market does turn, there could be there's some optimism with the stock. I have optimism with the stock. And reason being is I think there is a necessity for this service when you look at all the different areas of a particular business or corporation. You take, for example, during the slowdown, we are seeing a slowdown in IT spending. That is fact of the matter. So I'm not trying to say that that's not happening, but this is a shorter term thing. And the businesses, where are you going to trim? You're going to trim your non-money making areas of the business, right? Maybe some little recruiters or some little people here and there on the outskirts that don't do this. Whereas if you're a massive business and you want to, let's say, especially when times are slow, your priority is, let's see if we can bump up the number. Let's see if we can get these, make our company more efficient and optimize. You can't do that without analyzing the data. And I would lean on the side of saying that does provide this I don't want to use the word recession proof or recession resilient, but it is a very, very kind of like the whole cybersecurity discussions we've had over the past few. It's an area that just kind of has to be there. All these companies are transitioning to the cloud. There's just I think it's justifiable, but you guys can let me know down below. As I touched on, Warren Buffett is a holder. I say Warren Buffett, it's Berkshire Hathaway as the holder, and they've backed the stock since IPO. It is a small position for them, but it's still telling that it has made the Berkshire portfolio. Commonly believe that this was one of the other analysts that bought it, the asset managers, excuse me. So Todd Combs is actually who a lot of people think it is versus Buffett making the call.
Yeah.
Whereas Kraft Heinz, I think, was Buffett. So, but anyways, we'll take it. In terms of risks, clearly a lot of risks with this company because there are competitors as well. And one of the things that may happen is that, these big players like AWS or Azure, Microsoft, they may come out with their own in-house services that don't really desire the need for like a third-party company like this. But at the meantime, there's nothing really in the market that is offering their exact solution. And that's important because to me, we're looking at this from a 1-year time period. Right?
Yes, we are.
I want to win this battle.
Yeah.
Because I have been winning the past few and I want to keep that going. Right? If you guys have been following.
I think you've been leading so far. Well, and you won the last two before that, I think, too. So, yeah.
So, with this in mind, with a 1-year time period as of posting this video, I do think there's significantly more opportunity in a stock like this than in Kraft Heinz. And reason being, is because, again, what I'm saying is long-term, there are risks with this company. Mm-hmm. What I was trying to get at there, in that, maybe these big players don't see the long-term need for a solution like this because they can just build in-house. But over the next year, I don't think that's the case. And we've seen the tech areas and pockets of the tech market going crazy with AI and NVIDIA and all these announcements of AI integrations. Well, that absolutely is at play with a company like this. And they start throwing buzzwords out. They start announcing exciting things in regards to how they're gonna make their business more efficient on the AI side. I think that could be a big boost simply in terms of optimism and maybe not justifiably, but it would be. Actually, in June, later this month, I don't have the exact date, but I believe it's June 26th, they have a big investor event. So their big annual Snowflake event. And if they're able to have that be a nice generation of buzz, a catalyst of buzz, I think there are some things working in this company's favor over the short term. And again, after this big drop off, it's a different story if the stock was still trading at $400, but it has absolutely fallen, off a cliff. Price to sales is what I'm looking at here because there's no earnings. We can't look at a PE, of course, but the price relative to the revenue this company's making was basically sitting at 140. Now it's sitting at 25 times. Now, is that still high? That's debatable, but relative to where it was before, I think that this company has started to find a bit of a floor. And with the stock trading at $170 and a 1-year time period, I'm quite confident I'm going to win this battle.
And that is your pick.
And that is my pick, the company Snowflake.
Well, there you go. Wow, it's up to you now. You got to go out and vote and look for that community posting because we will put, and it'd be very easy to vote on there, but we still like to hear your feedback on these as well. You started off with this company called Snowflake, and then you talked about how it's been going, it went downhill rapidly.
Yeah.
And we always talk about starting with a snowflake and turning it into a snowball and rolling it down the hill and it gets bigger and bigger and bigger. Well, this has done exactly the opposite.
For sure.
So there's an uphill battle with the company right now. So
and maybe it's kind of dissolved, disintegrated, and then it's going to evaporate and kind of rise back up to this.
It very well
top.
Could. Yeah, I learned quite a bit about Snowflake because I was aware of the company previously when it IPO'd, and it was all over the headlines. But it's not the type of company typically that I would invest in.
And same here. In fact, I did know as I was doing my research for this. You always get excited to buy the stock as you're researching them. Always. Yeah. When it's a smaller company, I say, "Oh, this could be the next big one," and it could be. Yeah. But as exciting as I found certain things to be, there were still enough reasons where I wouldn't make my portfolio. That's just the discipline that I have as an investor. But that said, this is a battle. And for maybe some of our viewers, this is the type of thing that's up their alley, right?
Yeah, exactly.
Each investor is different and each has their own rules and guidelines as to what would make their portfolio. So,
and as a reminder,
two very different
always,
ideas.
This is a stock battle. It's to highlight these two companies, but we're by no means saying everybody has to rush out now and buy them. That always comes down to your own due diligence and if it's suitable for each individual person.
But what you do need to do now is go down to the comment section, drop a thumbs up first and foremost, and let us know what is your pick.
Boring Kraft. You talked about being recession resilient.
Yes,
and I think eating is. I think it is. And you're right, because things like KD and Heinz beans, they've always been considered to be sort of that lower echelon of the food chain. And yet there are even lower within the brands, the no-name brands and in-house brands, etc. So yeah, we'll see.
Time will tell.
This is a good one. I have no idea where the dust is going to settle on this one. But yeah, I think just be prudent out there and pick a good, solid, reliable, resilience company. That's my pitch.
Sure. Yeah. Well, thank you guys for watching.
Thanks, guys.
Reminder, as always, be sure to check out the Investing Academy, which is that first link down below for online course and training. If you're still sticking around, we just got invited, by the way, to the Money Show, which we'll be attending. We did last year. It was a blast meeting so many of you guys in Toronto. We're going again this year, and we actually got bumped up to a keynote. So we're on the main stage this year, going from one of the smaller side stages, which was still pretty big. For me, it was big. We're leveling up. They must have liked us. So we are coming back again. For anybody in the Toronto area, this is a completely free event to attend. And yeah, come say hi, come meet us, show the support. Whether I include a link in this video or an upcoming one, we do have a little sign up link that we can share with you guys.
Yeah.
So keep an eye out down below if you are in that area. It's not till September, I believe it is.
September 8th is the day we're in Toronto.
8th and 9th. Yeah, exactly. So yeah, stay tuned. I'm sure we'll have more announcements, but that is exciting. Dad? Well, let's see where the dust settles in this one.
Let the chips fall where they may, Brandon.
Yeah, as they say.
It's up to you now.
Thank you guys for watching. Hope you enjoyed, and we'll see you in the next video.